Welcome, everyone. Good evening. Thanks for being here. My name is Joseph James. I am one of your co-hosts along with my partners for Mercury portfolio here. We'll introduce the team shortly. If you have any questions about this particular deal or about Blue Ocean Capital, please put that in the chat or in the Q&A. We will try to answer all the questions as we go along, or if we don't get to your questions, we'll answer those at the end as well. All right, so this is the property we're going to talk about today, right? It's a 4-property portfolio. So this is the first portfolio deal that we are bringing to market. And this is a very exciting just for that reason, right? So you're getting instant diversification by investing in one opportunity. You're instantly diversifying into four different properties. So that is one of the beauty about this particular offering that we are bringing to you. Before we get started, a quick disclaimer. The information contained in this presentation is confidential and is solely for the use of providing information and education for prospective investors of Mercury portfolio. While the information contained in this presentation have been compiled from sources we believe to be reliable, none of the representatives make any representations or warranties as to the accuracy or completeness contained herein. All financial information used in this presentation and projections are provided for reference only based on assumptions relating to the economy, market conditions, and other factors that are beyond our control. All references to acreage, square footage, and other measurements are approximations and must be independently verified. Investors are advised to make investment decisions after reading the PPM and subscription documents provided. This is a 506C syndication open to accredited investors only. So this is what we're going to cover today. We're going to take you through an executive summary of the deal. And that's what most of you are interested in here. We'll introduce the team and talk about our credibility and our portfolio of previous projects. And we'll talk about the projected returns. And we'll talk about the market economy, the location, property overview, and why you should consider adding this to your portfolio, right? And then we'll take you through the business plan for this offering and the financials and talk about the acquisition timeline. And COVID is on everybody's mind, so we will address some of the questions you may have related to COVID, and then we'll get into the facts of this deal and tell you how you can invest. All right, so these are our sponsors for this deal: Chander Mishra, Eva Mishra, myself, Joseph James, Tony Anthony, Rick Chatterjee, and Charlie Yu. So we'll take a couple minutes to introduce ourselves. So I'll turn it over to Chander to introduce himself first.
Hey, thanks, Joe. I'm a physician, and I love doing real estate because it's kind of like one of the ways you can secure your future. I've invested in over close to 2,500 units. That's like a little bit older slide, but it really doesn't matter. I still practice medicine because I love doing that too. Why we do this is because what's important for us in this is that as soon as you buy an apartment building, make it better, you are changing lives of so many people. So that why is very important. And with that, you provide secure returns with the real estate for the investors. And that changes the future of so many people. And that's very important for everyone who is listening to understand that as we invest and grow together, it changes things for everyone involved. I'm also a member of CCIM and Forbes Business Council. And on to Eva.
Hello, good evening, everyone. Happy holidays. And I know 2022 is going to bring us wonderful things as 2021 did. My name is Eva Mishra, and I am the other half of Chander Mishra. And we are so happy you are here today to hear this wonderful presentation. We're going to be providing you great information about our upcoming syndication and our upcoming deal and everything. And my background, basically, I'm a business performance coach along with being a multifamily investor. I'm heavily involved with my community, being on the board of directors for several local community organizations. I really like to reach out to people and connect them. So I'm so glad you're here connecting with us tonight. Thank you.
Thank you, Eva. This is Joseph James. I'm based in Dallas, Texas. I'm a commercial real estate broker, developer, investor, and coach. I'm also the CEO of ROI Muse. ROI Muse is a commercial real estate technology and training company. We provide software tools, training and coaching for multifamily investors and commercial estate brokers. I'm a CCIM, Certified Commercial Investment Member. I've invested in more than 800 multifamily units, and we have also trained more than 4,000 commercial brokers and investors using our platform. So over to Tony.
Thank you, Joe. Good evening, everyone. Thank you for taking your time to attend this call. For those of you who don't know me, I am Tony Anthony. I have invested with Joe and Chander for the last couple of years. My investment experience includes real estate, land, office buildings, and so on. I am also one of the co-founders of ROIMuse.com, a deal analysis and lease analysis software. So if you haven't checked it out, please check out ROIMuse.com. My passion also includes crypto. I do crypto mining, staking, and investment pools in crypto. Once again, thank you guys. Welcome to our extended Blue Ocean team. We welcome you to our team and looking forward to working with you all in the future.
Thank you everyone for joining in. I'm Rick Chatterjee, started in multifamilies as an LP, got so interested in it, said, okay, this is something that I want to do. So I started looking more, getting deeper into it, and started working as a more on the GP side. As my background, got 20 plus years of experience in IT and managing global teams. And I hold a master's degree in technology from the IIT Delhi. And glad all of you are here, and glad we are able to share these kind of opportunities with you. Thank you. Over to Charlie.
Thank you. Good evening, everyone. Happy holidays. My name is Charlie Yue, and I'm a full-time real estate investor. I'm happily married and have a 10-year-old son. And I'm also very active in community service. And now I'm serving as the Executive Vice President at the US-China Chamber of Commerce. And I started investing in real estate back in 2004. In 2009, I became a full-time real estate investor until today. And I have done all kinds of transactions in residential real estate, and I'm still offering hard money loans to investors in today's market. And I'm very excited to have an opportunity to partner with the Chander and everyone in the team on this portfolio transaction. What I really like this portfolio deal is all the properties are in great locations and they are all in great conditions. And Chander and all the team members are very conservative on their underwriting. And Chander is also doing great in asset management. I have invested in Chander and James' other property before, and I believe this portfolio deal will perform very well. I hope you all will join us in this great investment opportunity. Thank you.
Thank you, Charlie, for that. And let's get into the portfolio itself right now, right? So this is a 4-property portfolio as it stands. So we have Saddle Ridge, 113 units in Weatherford, Texas. Country Oaks, 64 units also in Weatherford, Texas. And then Atrium Gardens 1 and 2, combined 97 units in Arlington. We had a complete shutdown with COVID, and then the market came back booming, right? So nobody had any idea what was going to happen in the market. The stock market went up, the real estate market went up. Now there is certainly concerns about, how much more the stock market can go up, and we are starting to see some corrections along the way. So stock market is dancing on a knife's edge is, one of the concerns here, right? So that's another reason why I look at real estate as a balancing, right? You want to balance your portfolio. So if you made a lot of money in crypto and stock market, time to maybe, go a little conservative so you can establish your base. So that is one of the reasons that we are bringing multifamily investment opportunities for you guys. 2021 was a crazy year. It's a year of opportunity to frame, right? And what we believe, and most people believe, that the greater opportunities ahead of us, right? So the home prices are going up, the median incomes are going up, the rents are going up, the property values are going up. So the next few years, there is the consensus is there's a good opportunity in multifamily, especially in fundamentally strong markets like Dallas, Texas. So that is why, these are things that you should take a look at and see if it fits your investment strategy. This is the new normal. We are not going back to 2 years ago. We are not going back to 3 years ago, right? We are in a totally different market cycle now. So this is the new normal. So what is your expectations post-vaccination, and what do you think the economy is going to look like? What we have to look at the fundamentals and invest in key trends and demand. Markets that are in high demand, and looking at key performance indicators for investing and selecting the markets and properties according to that. So why invest in multifamily? With real estate, you have so much benefits, right? The cash flow, the distributions you get from operations of the property. And when we talk about appreciation, you have forced appreciation and your market appreciation. So the market appreciation is typically what happens when, you know, either the rents are going up, that's going to pull the NOI up, and the property values are going up. On the same time, you know, the market cap rates are compressing, and as the cap rates compress, the property values are going up. And these are purely based on supply and demand and economics. So that is your market appreciation. But the beauty is that multifamily also gives you an opportunity to do what's called forced appreciation. And we are looking for properties that have significant amount of forced appreciation opportunities, where, you know, we can go in there with a big budget, renovate the units, improve the property, and push the rents higher and increase the value of the property. So when you're combining, you know, good market forces where you can expect some market appreciation, and then we are coming in with the strategy to, you know, implement forced appreciation. So that's why these properties have, you know, a great opportunity to, you know, give you a really good returns. And obviously with multifamily, you have large economies of scale. Instead of investing into 50 single family homes, you can invest into a, you know, 273 unit or 300 unit apartment complex, which is going to give us economies of scale when it comes to expense management and other factors. And one of the benefits of multifamily is the ability to have, you know, good quality professional management team. So the professional management team is on site. They can take care of implementing our strategies. So we can focus on making the units, making the complexes perform, and, you know, work on a more higher level function, because we have that ability to put good professional management companies in there. And multifamily obviously has proven as an asset class to be very resilient in volatile markets, right? And, you know, there is tons of tax advantages that comes with multifamily. That includes bonus depreciation, you know, accelerated depreciation, and other tax benefits of investing in real estate as well. And when you look at real estate compared to other asset classes, you can see this is your return and this is your risk over here. So you can see multifamily or real estate in general has a very low risk and very high return potential, right? And when you compare that to stocks, for example, you can get some returns on stocks as well, but the risk is also higher. So if you're looking to balance your portfolio, that's where you have to look at, how much, how is your portfolio balanced, and certainly have some real estate holdings, kind of to minimize your risk, total risk in your deals. And when you look at multifamily compared to other asset classes, you can see the returns, average returns on multifamily is higher than some of the other asset classes. But when you look at the volatility, which is the standard deviation, you can see the volatility is also low. So that gives it a very, high Sharpe ratio, which is a risk-adjusted return, and looking at the standard deviation for the investment class, for that particular class. And then you can see the higher the Sharpe ratio, the lesser risky that particular asset class is, right? So you can see multifamily or apartment tops that chart as well. So that is why we believe in multifamily. That's why we are so excited about multifamily. And that's why we are in this business of bringing you opportunities to invest in multifamily. So, multifamily is definitely a superior asset class to consider when you're looking at other investment opportunities and other real estate asset classes. With that, I will turn it over to Chander to take us through the deal and go into the details of why this deal and why we are so excited about this deal.
There are a few things which Joe kind of pointed out, and those are very important because those things are what makes or breaks a deal. So like we closed on a deal day before, and very interesting part of that is that within a day we had the CO done, because we had two people working there, and not only two people, we had a team working in the background to get all the utilities connected. We had CO done on that property, and in fact today we were there with a contractor in trying to create a plan of what we are going to do on an exterior. Now, we got this property when it is 100% occupied. And a lot of people ask that question, hey, you're buying this property 100% occupied. And guess what? This one also is 100% occupied. And there's a story behind it. And we look for these kind of properties. It means, and this property has a lot of legacy tenants. People have been there 10 years, 12 years, those kind of tenants. It means that people there already enjoy living there, and they kind of, and that's important. That's very important. And the reason it's 100% is because the management basis, when they bought it, it's so low that they had kind of, they were happy with the way the property is operating, and they don't want to push the rents. So that's where the opportunity comes in. We go in, we boost the rents, we make the property better, we add more money into it, and because we're adding more money into it, that makes that property shine and come to above market rents. And a lot of people ask about experiences. So this year itself, we sold 3 of our properties, and we're selling another one in the market, which probably will close end of December or January in the beginning. And if you look at it, I drove that property's rent from like $1.20 per square feet to $1.45, $46 per square feet. So we are so used to doing it in these properties that we know what we are exactly looking for. We want well-maintained property with a little bit of operational downside, so we can use that. And if you look at our rental assumptions, we don't try to push the rental assumptions above the market, like we don't count on the future growth. We see where we are at the highest, and we see if we can push the rest of the portfolio to the same level. And that's our strategy going into these properties. So let's look at it, what we are going to do, because this is very important slide. As you can see, it's 273 units. We are buying it at close to 33, you can say like 34 million. Loan proceeds are going to be 23 million. Loan to value is 75%. Equity raise is close to 11 million. And non-recourse bridge to perm loan, we have a budget, rehab budget of 2.32 million. And the purchase price, if you want in exact dollars, is 33.85. These properties have different vintages, 1971 to 1985. Minimum investment when you come in is going to be $75,000. LPGP split is 80-20. Once we return your capital, means once we have about double your money, turns to 70-30. The entry cap rate is 4.25. We are assuming an exit cap rate of 5.1%. Higher the cap rate is, means we are assuming that we will be selling it at a lower value, not from the lower value of what we are buying it at, but compared to the market at that point. So we are building a cushion in it. And we have an IRR, internal rate of return, basically that factors in your time for which your money is invested. It's 17 to 18%. Now, what IRR doesn't take into account is as the cash flows out of it, remember, you reinvest that cash and you get more return. So your total capital accumulation by reinvesting that money can be much higher than 17 to 18%. And that's an important thing to understand. And in fact, I understood it by going back, and a lot of the people on this call, including the team, like highly experienced. Charlie is very experienced. He has done this since 2004, bought in multiple complexes, sold in multiple complexes, and he has managed so many of them. Joe, he has taught so many, like 4,000 people. Can you imagine that? Rick has been managing huge teams. Eva, asset management, property management, she has done so much in it. Tony, think about a guy who does crypto. Miss Crypto is a high octane thing, investing and being a GP on a multifamily. There is a message there, and the message is simple, that you have to have a very comprehensive approach to what you are doing. So in this deal, you have 17 to 18% return on IRR, but you can take that money and invest in other things and grow that money more. The key part is that your basis of that money stays constant. So yes, you can make 7 to 10% money in a stock market, but guess what? Your basis today, you have got $1 million in your account, you're making 7 to 10% off it. Tomorrow it's 40% low, and you're still making 7 to 10% off it. So this took me a lot of time to figure it out. Why do people in real estate do better? Because they're not paying much taxes on those income. And also their basis kind of stays pretty stable. There's not much volatility. So if they are making 10%, that 10% compounds very quickly. While in stock market, since your basis is shifting constantly, that 10% may shift along with it. So it's very important to understand that factor as we go ahead and plan our lives and figure out what our future is going to be. Because I was looking at the data, a median household kind of like net worth of a retiree at age of 65 is close to $180,000, and most of it is in the homes. So think about it. That's the median value. Average all in is about $1 million for a retiree. So how do we plan for it? And how do we plan that our money is working as aggressively as we are working and go from there? So here you have a total passive return. Now, passive return is 91.1%. That means that you invest the money, and at the end of it, that's how much you should have accumulated in general. And these things are very important to understand, because when you are investing, any investment can go bad. And I want to give you a very big disclaimer about it. But what it is like, if you're working with a team which is committed, which is totally dedicated to producing results, and it's like unwavering dedication to produce results, you will always be in good partnership. The key is the people, and the team is what makes or breaks any kind of enterprise. So when you join with us, and yes, you join with us, we invest our own personal money in it. You will realize that it's a fun game. It's not as exciting as crypto. It doesn't go up and down in value every day. And guess what? You don't have to do much. We have found the property. We have done due diligence. We are going to get. We have found the lender. We have the whole legal team. We have everything kind of sorted out for you. All you do is come in and contribute your capital. And by contributing your capital, you become our partner. We take care of the management, asset management, legal necessities, everything else. If somebody would have told me this 20 years ago, this would have been where I would have put my money. But guess what? This is not widely kind of told. It's much more wider now. But 20 years ago, no one was even talking about it, that you can do syndication. So what is our acquisition timeline? We got this property off market and we negotiated the PSA. You can see December 22nd, the webinar is there. We sent the webinar invites yesterday, and still we have over 175 to 200 people on the call. So that's amazing. We assume that within a month, our funding will be closed. Last deal we had more than half filled within 2 days of reservations. So it is going to fill up very fast. We anticipate the closing date to be end of January, and that's our projected goal. Most important thing, what are you going to make? Because that's one of the most important question people say. And so if you invest $100,000, you are going to get year one, 7,000, year two, 7,500, year three, 8,000. Probably you'll get a little bit more here. Year four, 8,500. This is very conservative estimate, which I'm giving you. And year five, at the end of year five, you will get your 100,000 back plus another 59K with a total return of 90K. And this is a conservative estimate, which I'm giving you as you invest your money in the property. And this is the most important part, that how much cash flow you are getting. But guess what? Along with that, you get close to 96% in depreciation of your invested amount. So the people who are very experienced, they already know what I'm talking about. People who are not experienced, it just means that it saves you money on the income you generate from your passive income through real estate. Now, a little bit about our team. We have got Madison Speck, which is our cost seg firm. The reason I put him at the top is because everybody loves the depreciation. And at the bottom is McElwain and Associates, the CPA firm. Class A Management is going to be our PM company. Barcadia is going to be our lender. And Kelly Clark Legal is our attorney. So that's where we go from. A little bit about portfolio. We have a couple of these which we have sold, and some of them are on the market. Our portfolio is mostly in Texas, Dallas, Houston, and El Paso. And this is White Rock Lake. We just purchased this year. We haven't put Haltom Oaks here. We closed like a day before on this. So let's come and talk about why Dallas-Fort Worth. What's happening in Dallas-Fort Worth? So if you look at the Dallas-Fort Worth market, you have got a huge investment pouring in. And Dallas-Fort Worth led all metros for multifamily investment year to date. And this is very important because where you put your money is very important. You put in a market and you look at the other markets and you see comparative investment. Where is the investment moving to? And the reason investment is moving here is because people feel confident. People feel that if they invest money in Dallas Fort Worth, their money is going to be safe. And if you look at 2008, people talk about the crisis and what will happen. Now, just so you know, commercial real estate, apartments are considered commercial real estate. And even in the worst COVID situation, the government was giving the rental help. And a lot of our apartments were basically making more cash flow from the rental checks, which the government was making than what they made before. So in general, the multifamily is positioned very well to do better over a period of time in any of these markets. And if you invest in prime markets, then it makes it very much safer, because even if there is up and downs, you are kind of protected against that up and down. Look at this. Now, top 15 market for net absorption. So it means you have 56% of the net absorption over the 4-quarter year ending Q3 2021. And what it is that how does the market doing in terms of the new supply? Demand exceeds the supply, and the occupancy kind of is rising in these markets. So it's a key understanding you need to have, is that as the home prices are going up, the pressure to have that rental space is higher. People have to go in and pay a higher amount of money to have that rental space. And I was talking to the PM company, and they were saying that it would be tough to just price anything below $1,000 for a single bedroom in this market, because the cost of everything we are doing is going up every day. So let's look at here. What's happening here? So if you look at here, in the forecasted, the vacancy rate, stabilized vacancy rate, look at it. It's lower than 5%. Now see, that's exciting, because if my vacancy rate is lower than 5%, it means that there's a big demand and low supply. This is the data from the CoStar. So going on to another, so cap rate. So we said in the beginning that we are assuming our cap rate to be 5.1% at the sale. And the reason we do that is because of this. So look at, green is your Dallas Fort Worth. And this is a 5.2% line, which is going up here. And we are just below here, below 5.2. This is like a 5.1%. So that's what we are assuming. That's like your 2025. And we are at this, and that's the forecasted number. So we are taking that forecast and using it to define where it would be. Now, another thing I want you to understand is the market sale price per unit change is up 14.6% per year. Now, what people didn't realize is that from the time a property comes in the market till the time it sells, it's usually 6 months. So if you have a increase in the price 14.6% per year, and assuming that you held on to that, like in 6 months, let's suppose property came in the market, and by the time we close, this means that you've already gained 7% on your investment dollars. So think about it. Just pay attention to it a little bit, especially for people who love data. And what's happening in Arlington, and as you can see, of course, you all know Dallas Fort Worth International Airport, General Motors, Lockheed Martin, and Fort Worth is fastest growing, 15th largest growing US city. And of all those who do not know, Rivian is coming there too. And why I'm talking about it, I'll emphasize it a little bit later. And we go and look at the city demographics and why it's important. You look at the Weatherford. Why Weatherford? You look at 32.9% growth. You look at Fort Worth, 24% growth. And Arlington and Dallas is pretty much constant, but 7.9%, 8.9% growth. Now, this is not a 2% growth. This is not 1% growth. This is not negative. This is 7.9% people moving in. So assume a 8.9% of 1.3 million people. Calculate that, 10% of that. You know, just if you don't want to calculate, just calculate 10% of that. just 10% of those people coming in each year, adding to that population. So that's what is important to understand here. Now, going on to what's happening with the city demographics. So look at it, what's happening in Weatherford. So you see the population, the median household income, and it's amazing. It's kind of like, and I would say that I'm guilty of it. I never kind of like looked at Weatherford. How did I look at Weatherford? I got this offer to buy this brand new 300 unit property in that area. And that's when I started investigating Weatherford. And that's when I found out that it was one of the hidden gems and it was growing significantly. Look at the population growth in the area. While compared to Arlington and Dallas, huge population growth, median household income is amazing. You can see 68,000 versus 61,000 in Arlington. House values and growth since 2000, 137%, 125% in Arlington. So these two areas within Dallas Fort Worth is kind of like nicely positioned for any multifamily acquisition. You look at, of course, you got Texas Live. You already know there's a UT Arlington, big presence there. Lockheed Martin in between. You got Grand Prairie, Premium Outlets, Epic Waters, and Arlington Entertainment District. I went to this Texas Live and I couldn't believe it. Such a phenomenal place. There was a conference and it is amazing what they have done to that area. So with all that, why that is important? Because what's bringing people here? People are coming for entertainment, people are coming for jobs, and the economy is booming. And what happens when economy is booming? We like to buy places there so people can live around there. People who work there, they live there and they make money. They like to live in a nicer area and pay a little bit more for rent because it's closer to where they work. And you already know it's AT&T Stadium, Globe Life. You already know about that. Weatherford is huge and growing, and new developments are coming all along there. And if you want to focus on the property demographics, you can see here you got the median household income of 52,669, and that's Arlington. But guess what? Weatherford 62,410. Now that's shocking, isn't it? Because I thought Arlington people will be making more money, but it's Weatherford which is making more money. So for me, that was very surprising. And so when I saw this opportunity to buy these two properties in Weatherford along with Arlington, that was my dream come true. That hey, this kind of makes sense. So you can see these two properties in Weatherford are very close to each other. Country Oak, and it's very nearby Medical City, Weatherford Aerospace, and Weatherford College. And you can see in the next slide a significant commercial presence near these properties. And this is the overlay of that. So you can now see, you can picture it. What I'm trying to see is that you have intense commerce growing. These cities are growing because there's a huge pressure on Fort Worth, and people want some breathing room, and this area offers them that, and it has everything they need to live in their common life. And it's amazing to own a piece of property which is going to grow significantly over a period of time. Same thing, look at your Atrium Garden and in Arlington, and UNT very nearby. You got stadium nearby. You got all this around here. So all this is driving. And one of the things when we drove near the next to the property, it's close to AT&T Stadium, Globe Life Field, and everything else, Six Flags, and a lot of commercial stuff around it. So we drove it. It was so peaceful. The property is not in a kind of like a real noisy area. It was so peaceful driving next to the property. It just gives a very different feel. If you are in town and you want to go and see these properties, I will encourage you to go and see. And if you're an early real estate investor and you're coming in, I would encourage you to go in and drive the properties, because that gives you a whole different feel than just attending the webinar. So a little bit more on property information. As you can see, this is the aerial view. this gives a significant extra space. This one has 2 pools and very nicely well located. Now I want you to just pay attention to it. All this area, there's a balcony on the top, there's a balcony area in the bottom, and that's all part of our plan to give them a little bit more space and create some fenced areas, so give them a privacy and use this area. We still are planning about it to develop or at least create a plan and create some kind of way where we can either give our next, when we sell the property, to give it as a value-add opportunity for the next buyer. But if we can, this will be a great place. Like you can see, we can put a bunch of units here. So there's a huge expansion area, very well located in the property. So I always look for something additional when I buy a property. We bought a property early in February this year, so that we're building, we initially stated like 10 units, we're going to build studio, we're building 12 units. So it's each property, we try to find something unique. What we can do, irrespective of what happens in the market, which will give us an edge. So we look at, macro piece that, okay, multifamily is a good element. Then we look at the area, which is Dallas-Fort Worth, very high in demand. Fortunately, we live here, so we're going to take big advantage of it. And then we look at the specific pockets. And that's where the whole idea comes in. Because as you grow from bigger to smaller, you just kind of zoom in and try to find a unique opportunities which will fit the bill for us to acquire. And so we try to find our own blue ocean. So we are not competing with a lot of other people in this. These are again some external pictures of the property, as you can see. What I want you to focus here is basically just a plain appearance. So there's not much done. So there's a lot of room to improve. There's a lot of room to put in like granite. There's a lot of room to change some colors. There's a lot of room to kind of bring it to like more grays, bring in more like what we do here, granite, backsplash, and those kind of things in all the units, and put in some nice black appliances, nice pulls, upgrade the fixtures, and kind of keep, so the property is very clean, as you can see, well maintained, but what we are saying that take it to the next level. So that's the plan, to take it to the next level. And that's where we add value. So as you can see here, that's the post-renovated, some of the concept units. You can see black appliances and some new color scheme which is built in. And that's the main what we are trying to achieve over a period of time. A little bit more like details on each properties, as you can see, master metered. Most of them are like pitched, composition roof. There's the opportunity to do rubs in most of them, to build a certain amount of utilities back. Of course, we are going to do utility conservation, LED lights. That's our usual plan, and that's very important for us to understand as we think in terms of improving these properties and taking it to next level. As you can see, Saddle Ridge was 1977. It was renovated later on in late 90s and 90s and 2000. This one, Atrium 1 and 2 were 1971, 1978. And Country Oaks was built in 85, and a lot of work was done in 2000. So both Saddle Ridge and Country Oaks received significant number of dollars in CapEx over a period of time, but it has been maintained in a very kind of a bland fashion. It's outside, you can see the color scheme is mostly like, military barracks, like dark brownish. So we're just going to play with it and see how we can improve the looks and make it more attractive in general. So looking at comp analysis, like what are we going to do? So potential to increase the rent to markets before and after upgrade of the units. So in our assumptions, when we have looked at the property, the rents are below market in a significant number of units. And you can also see there are some sections where the rents are leading in the market. So that shows that there is a driver where we can push the rest to that. So that's the main part. Supply demand drivers, there's a high demand, as you know, there's very low supply, purchase power, ability to buy at, as you can see, we are buying close to like $119,000 to $120,000 a door, and ability to sell at the higher price as determined by the market cap rate. So this all goes into the equation of figuring out how this whole acquisition is going to do over a period of time. Now let's look at it, something very interesting. So Country Oaks here, this is one of the properties we are acquiring, is $1.77 per square feet. Now that's amazing. So if you look at it, if you 806 for the studio, and you can easily push that to $2 rent, $2 per square feet in a smaller apartments. So you can see 473 average square feet per unit, and you can see their rates. So there's a huge opportunity to push it. Going further, you can see here Atrium Gardens, $1.25. The highest rent, which you can see in 70s product, in basically here is $1.44. You got $1.57, and also here you got $1.70. So you see that's what we want to achieve. That's where we want to be in these acquisitions, because that's the opportunity. Going further, Saddle Ridge, same $1.20, and you can see the same, the sister property is at $1.77. So there's a big opportunity, there's a big delta to move this up. So these are 113 units. So think about it, even if we can push it to $1.60, $65, and we're not going to do it over a single day. It will take us some time. So we have assumed that it will take us about 18 to 24 months to turn this around. And that's already in our assumptions. So you can see one bed, one bath, where the rents are going. In certain areas, we are the leaders. In certain areas, we are lagging behind. But then there is a potential to get all there. Again, the same thing. You see the Saddle Ridge is there's a chance Jameson Street is already at higher side. So the concept is proven. The concept is not new. Here you can see Atrium Garden, we are lagging behind compared to some of the other ones, where other ones we can, so there's a huge opportunity to push it a little bit higher, as you can see in both 1-bedroom studios, 2-bed, 1.5 bath, and 2-bed, 2 baths. Now let's looking at it rent trends in Weatherford. So look at the rent trend in general. So I'm not talking about the future growth. I'm just talking about right now. So the Parker County is 1 to 3 star rent is close to $1.50. So that's like an average where this is not an assumption. That's where we are today. So this is not projecting, okay, I'm going to get 14.5% for next year. No, I'm just saying this is where we are today. The property is lagging behind and we have to push it there. So that's where the money is in this whole transaction. The same thing you can look at Atrium Gardens. Atrium Garden is basically this blue line. Arlington 1 to 3 star properties are way up here. So this is the delta we are trying to capture. How we do it? First day we go in, we set the rent here, and then manage this gap over a period of time, and keep doing renovations. That's the secret sauce, and I'm giving it to you here, very simply and plainly. I took a property over yesterday. We were on an average rent, like we closed day before. The rents are already $950 and $1050. That's our assumption rent, which we had projected 3 years from now. First day, that rent went into an effect. So as the leases kind of renew, that rents get flipped. So we are going to be renting those at a higher rent. We improve the property from exterior. As we get vacant units, we upgrade it, rent it higher. That's the way to go. You can look at here, Parker County 1 to 3 star, Country Oaks apartment is still lacking. So you are approaching that $1.50 very easily right now. This is not future. This is today. And there's no supply. The pressure is building, and it's going to be very favorable. Overall construction summaries, you can see there's only 135 units coming in next 8 quarters. Same thing here for the Saddle Ridge. You can see 106 overall construction summary in Arlington. There's no space where you can build. You can see in the whole area, there's not much there for them to build. Now look at the sales price, because this is very important, because projecting into future, where do you think this is going to land? So you can see we are buying it somewhere here, and we think that in 25 the pricing is going to be there. So that's the market data which is telling us. The same thing with Atrium Gardens. You can see this graph, the growth which is there. This is just the growth in the market from supply and demand ratio. This is not based upon what we are doing. This is what market is doing. So the market is favorable for us to kind of go forward with it. So you can see the same thing happening here, Weatherford and Arlington both. So what's the business plan? So in general, operational efficiency, focused, high social impact approach. So you've got 100% occupied portfolio. That's what you're getting. It means the property has good ratings. We just have to push it up a notch and add income producing amenities like covered parking, Wi-Fi, high-tech packages, and change the tenant profile, bring the rents to the market and improve the Google rating, and basically creating the value. What does the tenant want? And understanding that from our tenants and from the staff which is on the site, and understanding that in a way that it will help us do better over a period of time. This is, again, the projections. 2024, you can see this is what they have projected. The cap rates are going to be about 5.1% on an average. So that's your average cap rate in general, looking at that. What kind of work we are saying? Reserved parking, carports, play area, barbecues, and pergolas. Those are very much in common. Storage sites, miscellaneous paint, roof, curb appeal. We always put that in there because we are going to do some work in all these properties anyway. Water conservation for all the properties, high-speed Wi-Fi in general for all of them, tech package, washer dryer, connections, and unit upgrades. And this is usually runs $5,000 to $6,000 a door based upon what it needs for that particular unit. Now, looking at financial stress test, and this is what it is. Even if the occupancy drops 77%, we are still good. 20% economic vacancy. This is our DSCR, year 1, year 2, year 5, means debt service coverage ratio. So if it is 1, means we will still be able to cover our debt. Year 2, 1.3 means we are getting 30% more money than what we need to pay the debt. Year 5, we have 70% more money. Rent shock, 10% loss in projected revenues for year 1 and year 2, we are still okay. Maintaining status quo, no rent, no expenses increase, we still have the deal still cash flows at this pricing. Now, what happens when we exit? Best case scenarios, if we have a 5% exit cap rate, we will have an 18.7% return to our investors. If we exit into just like today's condition, below 4.5%, we'll have a 25% return. If we exit at 5.5%, we'll have a 13% return. If the worst case scenario, if you exit at 6%, everything is going bad, we'll have a 9% return. We think that this is where we are. This is our conservative estimate in the middle. And that's what we think about it. Deal still cash flows, as you see, so it's a great deal from our perspective. Tax advantage, bonus depreciations. As you can see, there's a significant depreciable value. Overall, 1 to 6 year bonus depreciation is $96,000. So 96% of the money which you invest, you have an ability to depreciate in general. So this is very important for people who continuously invest because this offsets their other passive income and active income if you are a real estate professional. So that's very important for you to kind of know. And I have a lot of physicians who just invest because of this. So in general, investment offering summary, 80-20 equity split switches to 70-30 after you get 100%, 7% pref return. This is very important. And this is cumulative. So if you don't get your 7% any year, it just stays there in your name. And whenever the cash flow picks up, you get paid. Overall, 8 to 9% cash on cash return, 17 to 18% IRR. We are putting in more than 10% sponsor equity, 5 to 6 year hold, 91% total return. There's a $75K minimum investment. The fees are 2% acquisition fee, asset management fee is 2%, 2% capital transaction fee. The PM, property management Class A charge is 3.5 to 4%. And what you can expect from us post-closing, monthly reports, all investors will receive monthly summaries, occupancy, cash flows, balance sheet, T12 financials, all are uploaded to a Dropbox as soon as they're available from the PM company. Expect your first distribution. So let's suppose you invest today. We close in January. Remember, it's a closing date, which is counted from that 6 months. You get your first distribution, and then we distribute quarterly after that. You can call us for any communication you need regarding your property, valuations, and so on and so forth. And we all believe in transparency and open channels of communication. And there are a bunch of us, so it's not just one person. So you can reach any of us, and we'll give you the answer. If we don't know, we'll find an answer for you and help you tide over whatever you are trying to do. How to invest? You just go on our portal and you sign up. You have to be an accredited investor. For those who do not know, they have to have $1 million net worth or a $200,000 per year income for last 2 years, and expecting to make the same this year, or 300 if you're filing jointly with your spouse. 300K a year. Create investment profile. There is a way you can create profile for individual, joint, IRA, solo 401K, or LLCs. So basically, there's an entity profile for these. There's another profile for joint, and there's a profile for individual. The way it works for individual, it's very simple. For joint, you just enter your spouse's email. Once you sign the paperwork, it goes to them, and they sign it, and we sign it, and it's all good to go. And then you wire the money. This is the URL. You can go to sign. You do all the paperwork online and do fund after signing. And because some of the time, and that's one of the things which we are trying to get done because there's so many moving parts in closing, and we want to make sure that we are funded and we are good to go. This is just what we talked about. So the key is to invest, and it just shows you where the rent surveys are. It shows that the rents are well above $2 per square feet in the market. I'm not saying we are counting on $1.65. We are not pushing it to $2. Means look at what's happening in Phoenix and some other markets. The same thing is hitting here. It's no longer a surprise. You've got a very strong team here, and not only strong in the sense of experience, but also very committed. And not only committed, but very open communication and trying to figure out this is not, we are asking you to invest in somebody else's deal. This is something we do it ourselves. We live and breathe. We do this 24/7, even 48/7, I'll say, because our phones are always buzzing, our emails are always running, and this is what we live and breathe whole day and whole night. These are the facts. One thing I would like to, you wire the funds, and you get a K1. K1 is basically a partnership return, and you will get that bonus depreciation will show up on it. Do consult your CPA and financial advisor before making anything. I'm not an attorney. I'm not a financial advisor. I'm not a tax person. You can reach out to any one of us. We'll share what we know, but do apply it in your own particular situation, what it is and how it is. You can contact us. You've got all our emails and personal cell phone numbers. It just comes directly to us. It's not going into voicemail, means not going into a company voicemail or anything. These are our direct contacts. And thank you very much. Really appreciate you being here. Why I'm doing this, I teach a lot of physicians about burnout. So one of the common reasons of burnout is, we do a lot of hard work, and you'll be surprised that under 40% of physicians who are under 40 years old don't even have a net worth over $1 million. So it's not about making a lot of money. Some people think, you can only do these when you have a lot of money. That's not the case. The case is how well you invest the money you have and what it's doing for you, because that's what is important. And with that, I wish you a Merry Christmas and a Happy New Year. Thank you for spending this time today with us.